So Pablo Calderini, I am CIO and president of Gram Capital. Gram was founded in '94 by Ken Tropin. We are headquartered in Rowayton, that's in Connecticut, and we also have offices in London and Palm Beach. About 180 people, $19 billion currently. 70% are in quantitative macro. So that's a short way of saying many quantitative algos built by PhDs and traded systematically. And then about $6 billion, which is 30% in discretionary macro. So there we allocate to portfolio managers. We have about currently 15 portfolio managers with their own teams, right? So that's more than 15 people. They're doing research based on macroeconomics, central banking policies. They will look at things like fiscal policies, global risk premia, sentiment, geopolitics, and then they build portfolios that try to make money given what we expect are going to happen in markets, right? Mostly driven by macro catalysts. So is that enough for the introduction or?
Okay. Yep. Yeah. I think this is what your slideshow is.
Good. Yes. So look, I think that, as you know, 2022, it's really a sea change to what we have been going through in the last, I would say, 12, 13 years since the great financial crisis. As you know, I will focus on that in 5-10 minutes. So on the slide. So really, as you know, the shock to inflation is a real major shock to asset markets, right? For the last 12 years since the great financial crisis, every global central bank has been not only doing very accommodative monetary policy, either in the form of very low interest rates and quantitative easing, but they have also been proactively trying to suppress volatility, right? Like I like to say, every macro shock for the last 12 years, every time that one of your portfolios got shocked by an event, low growth, China, this, that, it was met by a very friendly policy by a central bank. And inflation is a game changer to that, because inflation is a macro shock, big macro shock, but cannot be met by more accommodative policy because the Fed now has to tighten. So for the first time in 13 years, you have a macro shock event, but to portfolios that has to actually be met with a response that is even worse for portfolios, right? Which is tightening of monetary policy. And that's an environment that is going to be with us for a long while. Right? We cannot go back to the era of very low interest rates unless we have a very big depression, and that in itself will be another source of stress for portfolios. So the role of macro in that context, and the way that in particular we trade macro, right? We trade macro with a very strong fundamental background. We look at all the macroeconomic catalysts and very, very focused on central banking policy. But we're also conscious that we're in portfolios really to complement the portfolios. We don't take a really long-term view of the macroeconomy. The way that we can serve a portfolio is by thinking very short term, right? So that doesn't mean that we don't do a very deep analysis of where central banks are, where we're in the cycle, so on and so forth. But we are not going to have a view that, for example, because of inflation, gold is going up and we're going to be long gold no matter what. Maybe in a simple way, like I like to say, we want to be long gold when gold is going up, right? And if gold is not going up, we want to be short gold. And of course, we don't have a crystal ball and we cannot exactly predict how things are going to pan out. But through very deep research and by being very tactical in the views and very disciplined in the approach to risk management, we can sort of get there and provide the complement to the portfolios that portfolios need in times of market stress. If you look at most of our funds, whether the quantitative funds or the discretionary funds, that in itself is great. You put something with low correlation and decent return in a portfolio, the Sharpe ratio will go up. That's just the mathematics of portfolio diversification. The second property is almost more important. It is when you look at very big market equity corrections, say corrections of more than 10%. Our strategy has almost always made money, right? So that, in a statistical, more technical way, is called negative conditional correlation, right? So conditional on the event of equity markets are looking terrible, our strategy tends to, and macro in general, I just don't want to say gram, macro in general tend to do really well. And that's a very good property to have, right? Because one thing is to be uncorrelated when equity markets are up or down 1%. Another thing is to truly be uncorrelated when equity markets are down 15%, right? That's when you truly need diversification. And that will severely curtail the drawdowns in your portfolio, right? So I think that's how can macro complement the portfolios as well. So with that, let me go to the first slide.
Okay.
So we've done a lot of research in terms of how do markets behave in high inflation cycles, in cycles when central banks have to hike monetary policy. And this here is a very interesting chart, right? It's a chart of the correlation, how things move together between the S&P and the 10-year bond, right? Now, these are the two biggest asset classes, right? And this is, if you think about this very general canonical portfolio, it will be 60% stocks and 10% and 40% bonds, right? And that's why I have this chart here. But you can replace S&P by any other equity index. You can replace S&P by private equity, in a sense. You can replace S&P by credit, and you can replace the 10-year by global bond markets, right? By the Barclays Global Aggregate, and you'll get more or less the same results, right? So very interestingly, number one is that if you look at 100 years of stock-bond correlation, the correlation on average is zero, but it doesn't really live at zero. Very rarely it's zero, right? It's like we almost have these regimes, right? That we lived in a regime of very strong negative correlation, which is phenomenal for portfolios, right? Because bonds gave you the diversification that you needed in your portfolio for the last 20 years. And it's been going on for so long that people do think now that bonds are negatively correlated to stocks. But in reality, if you look for the 40 years previous to 2000, stocks and bonds were very highly correlated. So bonds were no diversification for portfolios, right? Of course, they are not 100% correlated. So they offer some diversification, but not as much as we experienced at the lack of experiencing over the last 20 years. So what drives these regimes? And it's mostly really inflation and monetary policy. What's particular about the 80s and the 70s and the 90s is that we lived in a world of much higher inflation. And we lived in a world of Paul Volcker, much more aggressive monetary policy, right? Whereas in the last 20 years, we have lived in a world without any inflation. Inflation was a problem on the way down, right? We had deflation. Central banks were concerned about deflation, so they were trying to prop up asset prices, right? And we don't have, again, a crystal ball, but our research and most researchers are thinking that for the next 10 years, we're going to be in a world closer to the 70s and 80s than the world that we lived for between 2009 and 2021. Can we go to the next slide?
Sure. I just had a question. Is this purely because of policy issues? Is it purely because of coordinated central bank actions? Or, I mean, has anybody considered like deglobalization and the impact of that on
yes.
Supply chain disruption?
Everything that you're naming are good things. Number one, you should see the period of 2009, 2021 as an anomaly. We're not going back to an anomaly. We're going back to how the world was mostly always.
Negative interest rates on mortgages.
Exactly. Negative interest rates and negative real rates are not normal, right? That's not how the world lived for hundreds of years, right? So we're going back to normality. Is that the last 10 years have been very anomalous. But yeah, the issues that you're mentioning are exponentiating the problem. Of course, clearly deglobalization, right? I mean, the issues between the issues with China, the war in Ukraine, all these are showing that the world of complete globalization where we can have things made everywhere in the world is a very fragile model, right? So you have to change to less globalization. That brings more inflation, but it's mostly monetary policy. Central banks have to bring inflation down. Inflation at the core level, so if you exclude energy, the volatile energy is running at 5% here, it's running higher in Europe. It's not going to be easy to bring that inflation. And in order to do that, you might end up causing a recession, asset markets behave in a very, very volatile way in recessionary periods as well. So what I've done here is just zooming into a shorter time frame, and you can see that even though, again, we have lived mostly in a world of negative correlation of late, as you can see in the end of the chart, is positive, and that's something that we expect will continue to happen, right? So bonds are not going to be the diversifier that they were in the previous periods, and you can understand simply why. If the shocks are inflationary shocks, the Fed and the ECB and the Bank of England and every other central bank has to respond by increasing interest rates. When you increase interest rates, that's bad for equities. Equities and bonds go down together. That's how positive correlation is defined. If we go to the next slide, please. This is a little bit not. Can you enlarge? Are you able to?
I can enlarge it, sure, yeah. That good enough?
Yeah. So what we have here is on the top you have, so let me start at the left. So at the left we have different regimes for the Msci, right? So very bullish, up 30% or higher. That's on any given year, right? In the middle you go 0 to 10%, and then at the bottom terrible markets down 30% or more, right? So we have a definition of different regimes for the equity market, right? And then we have how different hedge fund styles have performed in different markets, right? So we call the fact that most styles perform really badly in bad equity markets, we call that diversification, right? Because you're really not diversifying. Some of these styles can do well when equities are doing well, not as well as equities, and can do equally bad as equities when equities are doing bad, right? So, the nicety about macro and trend following as a style is that they do give you that diversification that when things are really bad, they are going to be contributing positively, at least not negatively, to your portfolio, right? And that's how we see the role of macro in portfolios, right? If you look at the typical endowment, you need to have private equity, of course. You need to have equity long short, you need to have equity, and you need to have bonds. But all these things are going to be going down if inflation keeps going up and if real rates keep going up, right? So you need some part of your portfolio that can perform well in those environments. Now you can say, I can buy puts, and puts will perform even better than us, long puts on S&Ps. But the problem that's a very expensive strategy, right? Macro can make money even if equities are going up. Maybe it will not perform as well, of course, as other strategies, but there's not a cost. Maybe there's an opportunity cost, but not a cost. Like if you buy puts, you're going to actually lose money if equities go down.
So is your statement that, people have to implicitly understand direction where they think the market is going, or do you have a statement on where the direction of the market is?
So
on this chart?
What I'm saying is that when you are building a robust portfolio is really not so much predicated on what's going to happen, because we truly don't know, okay, right? So you really have to think about having diversification on your book. And diversification is very much predicated on the correlation structure. And if all things are correlated, it's really hard to find diversification. And macro is one of the very few styles, maybe the only one, that has shown through different cycles that can have that diversification, in particular when markets are doing quite bad. But now you might say, genuinely, well, look, the returns on average to macro are not that high. Well, these are in the last few years, right? So we lived in a world truly from 2009 to 2021 when global banks were suppressing volatility everywhere, right? Things were not moving. So it's a really bad period for macro. Even though we managed to make money, we, as a style, macro, not only Gram Capital, macro as a style made less money than what on average made before, right? Because markets were super uninteresting. Things were not moving so much, right? It's not like now where everything is moving. And that's a prerequisite for us to making money. We can have a thesis about what happens when central banks move, but if markets don't move, then we don't make money, right? So we need to make money, we need two things. We need to be able to forecast markets and then to have markets that move in a meaningful way towards the direction that we have forecasted, right?
Right, so we had a technical analyst this morning who was arguing that, the red part would be the predictable direction of the market, where we used to show that that macro indexes tend to outperform.
Well, I mean, that's, yes. Okay, so let's stop for a second. If you ask me about our current views, right, which I guess that's fair, yes, we do feel that we are in a situation where the Fed has gone, so let's be mindful that March of this year, which is not too long ago, the Fed had interest rates at zero and they were still doing quantitative easing, right? That's a few months ago, right? And we had inflation going up a lot, right? Through the summer, the Fed has woken up and has become a lot more realistic and engaged with bringing inflation down. And then, as you know, Chair Powell had a speech in Jackson Hole 2 weeks ago. I think that speech to me is a landmark because it was short, it was unapologetic. It's almost like when you are really upset with your children, you're not going to be explaining too many things, right? And it was 9 minutes. He mentioned price stability 9 times. There was no in the one hand or the other hand. He basically said the labor market is completely out of equilibrium. We need to bring unemployment down. There's going to be pain, but if we don't do this, there will be more pain. Rates have to go up. The Fed will do whatever it takes to bring inflation down. So we know we are going to be in a very difficult market for a while. And then the big question is, are we going into recession or not? Our current thought is that it's more like a 50-50. If you look at the inverted yield curve, that will tell you that there's a very strong likelihood that we're going to be in recession. I actually, and I think we posted this on our website, I presented at the JP Morgan Quant conference about the forecastability of the yield curve to predict recessions. And the last 7 recessions in the US have been predicted by an inverted yield curve. So I actually think that there's, in my view, more than a 50% probability of going into a recession. It might not be that deep, as of course it's not going to be like the recession of 2008. But recessions are not a great time for equity markets. We feel equities have to correct more. If you look at price earnings, both the earnings and the prices have to correct. The earnings, an economy that was growing at 6-7% and it's going to grow at 1% will of course put pressure on earnings. Wages are still going up. And then if you have to price some recession risk, the equity risk premium has to go up, which means equities need to sell off so that the same level of cash flows give you a higher return. Right? So that's our view. We feel that commodities are still in a very deep imbalance between demand and supply. So we are still fairly bullish on commodities. There's a little bit of a question mark on China, and there are no COVID policies. But overall, we feel that commodities will continue to perform well. We think both have interest rates have to go higher, but 90% of the adjustment has been met. And then on the dollar, to me, it's a tale of $2, right? Against the euro and the pound, the dollar will continue to appreciate. What's going on in Europe is a complete tragedy. The Nord Stream 2 has been cut by 80%, so Europe is heading into winter without energy, and that's really very recessionary. It also constrains if you think about the euro, every channel is negative, right? The interest rate channel is very negative because the ECB will not be able to hike like the Fed. So that means from the interest rate channel, the euro suffers. from the balance of payments suffers, the euro suffers because not too many people are going to be investing in European assets. And from the current account channel, the euro suffers because energy costs continue to go up, putting pressure on the balance of payments. So the three channels that we use to think about currencies are negative for the euro. You can say more or less the same about the pound. The yen, I think, is a different situation. I think that the yen has been lagging because of the interest rate policy of the BOJ, but the yen is so incredibly cheap now, plus the yen is a safe haven asset. So if we go into a recessionary time, that's a good asset to own. So we are less negative on the yen, more negative on euro and pound and Chinese yuan. Did I forget an asset class? I think I didn't. So
Commodities, and your thoughts on China, just in general, or?
So China depends on really this COVID policy. I mean, clearly the macroeconomy is suffering, but China now going into this political cycle that they're going to, likely they will stimulate the economy, likely they will relax, likely they will relax a bit their one COVID policy. So we are very short the currency, but we are not thinking Armageddon. We're thinking yuan down maybe another 5%. Chinese equities maybe down a little bit, not down as much as US equities. So bearish, but not so bearish. I think that the continent that looks terrible is Europe, right? I mean, you have all the problems in Italy, the elections next month in Italy, the instability even in the UK, right? As you know, Deutsche Bank has published a very well-written report talking about the potential crisis to the balance of payments in the UK. The twin deficits for the UK looks very bad. And then the situation in Europe is just tragic, right? I mean, Germany made one of the biggest strategic mistakes that any country, in Italy as well, right? That any country can make in the history of humanity, right? Buying 60% of our energy from a country that is not an ally is just remarkable, right? And that's what they will have to adjust now too, and that's not really an easy thing to adjust. You really need to find sources for 60% of the energy that you consume, and you need to do it
right. Somebody remarked that there's not enough liquid natural gas in the world to replace the need of Europe.
No, absolutely not. Yeah.
Great. Next slide.
Yes.
I was just going to ask if I could, Marty.
Yeah.
It's situation in Taiwan. If that gets worse,
yes.
How does that impact what you're seeing in Europe?
Yeah, well, that's terrible. Yes, I mean that's a clear. I mean, when you think about the tail risks that we can go through, that is the major tail, right? And I mean, one can be hopeful, but maybe shouldn't be too hopeful. Yeah, but that's a major. That's a major. Right? I mean, so it's not only semiconductors, it's risk premium, right? I mean, one thing is this conflict between Ukraine and Russia, which is a terrible tragedy, but it's somehow localized, and Russia is not a big country to begin with. It's not such a big player to begin with. It's, of course, very impactful to Germany and Italy because they're importing energy. But outside from that, it's really not such a big event. And I don't forecast at all a military conflict between China and the US, but big tensions coming from something Taiwan, China, it would be really bad for risk assets overall. Good. So this is just an example of how adding to your traditional 60-40 portfolio, and I know you're more sophisticated, so that's not what you have, but that's a benchmark, right? And how adding macro, which is uncorrelated, can significantly improve your Sharpe ratio, right? From a Sharpe of 0.3 to 0.5, just adding 10% of macro, right? And that's partly because of the returns. Much more importantly, is because of the correlation, right? When you add an asset that has no correlation to the portfolio, volatility tends to drop by a lot, right? So I think that the numbers speak for themselves.
That's it.
Yes, so I don't know.
Any questions from the audience or any thoughts? So did we talk at all about real estate? Like there's a question about Chinese real estate.
So we don't trade real estate.
Okay.
And I know there's been many experts before me about real estate, so I wouldn't.
Does that impact your worldview at all, or in terms of the
I
China?
mean,
real estate
well,
market?
it's part of our view in terms of how of the two things, how weak China is, right? But that they are going to stimulate, right? Because Chinese cannot afford to have a complete meltdown of the real estate, right? That creates all the social tension. So we expect that in the next month, 2 months, there will be much more stimulus coming out of China, maybe relaxation of the COVID policy. That's more iffy. We thought so 2 months ago, and then we've seen the Chinese actually have taken a harder line than what we expected vis-a-vis COVID.
Right. So in some respects, you're thinking China is more incentivized because it's such a large part of the global world order to try to maintain, and they probably wouldn't act, you know.
And if you think about China, the Chinese saving rate is so incredibly high, which I think is what a lot of people missed for so many years, right? Kyle Bass's argument of China imploding, I think it only looks at one side of the ledger. When you have 50, when your saving rate is 50% of your GDP, you can truly build so many empty cities, right? It's just called that consumption instead of investment. And you end up still with a country that on a balance sheet level looks actually quite decent, right? Because you save so much, right? Right? Remember, the US had a saving rate of 4%, while China had a saving rate of 46%. Right? So that's not a long run equilibrium, but you can afford to do a lot of waste and bad projects, right? When you save that much, right? It's almost like for a household, right?
What about the trillions of dollars in debt associated with the real estate that it's really even off balance sheet for municipal debt?
Yes.
Real estate debt and with zero COVID policy, now that debt is starting to default.
Yes.
Do you think China is large enough to bail out all the defaulting debt at that size?
Look, I think that the balance sheet doesn't look very pretty. I mean, I think that the Chinese economy has many issues. I'm not saying that China looks like a great investment. I did say that I think Chinese equities are going to go down, and I think that they will have to evaluate the yuan. We tend to focus on the short term. We are not doing private equity investments in China where you need a 10-year view of China. In the next 3 months, we think that China has enough ammunition to control the situation and enough willingness to control the situation. And so we're bearish, but we're not as bearish. Whereas in Europe, they have no levers because they have no energy. Right? So Germany is heading again into winter without water in their rivers and without energy in their factories, right? So that's a much worse situation to be in.
So most of the duration of your worldview is a 3-month scenario, basically. I mean, you said earlier you're not doing long-term macro.
Yeah, look, our view is the following. You need to know, you need to understand monetary policy, fiscal policy, long-term trends. But at the end of the day, if we are going to be a good complement to portfolios that are already invested in the long run, you have private equities, you have equity long short, you have bonds, or you build a portfolio that you don't change every month. We are going to add value by being tactical, right? By being, that doesn't mean high frequency, that doesn't mean we change our views at all times, but it means that we don't have views, but we keep those views with a very tight leash, right? And take the case of gold, right? How many people said you need to own gold because in an inflationary environment, gold, and what we saw really is that real rates are the main driver of gold, and real rates needed to go up to rein down inflation. So we became bearish gold, right? And that's more of a short-term view, right? I agree that in the long run, if you're going to live with 5% inflation, gold eventually will have to do well, right? But in the short run, if central banks are tightening policy, gold is not going to do very well, right? And that's the part of the shorter term approach, right?
Right. I mean, we actually have another technician who's going to come out and say gold. But I'm like, that doesn't, I don't see the world heading back to gold, et cetera. Eric, you have a question?
I have one question. The Fed, Powell gave a speech, and as you said, it was a very forceful speech, like
Yes.
you might give to your
Yes.
children. But counterbalance to that, you have the administration, you talk about real interest rates. Well, we may no longer have real principal anymore. Just kind of wave the magic wand and
Yes.
raise $1 trillion of student debt.
Yes.
The Fed seems to be handicapped coming up with.
Well, no, you are right. I mean, the fiscal imbalances coming out of Washington has been a problem, right? And some people, like I tend to think that inflation is more fiscal than a monetary problem. And I think that those imbalances are making the Fed's life very, very difficult, right? This last $1 trillion,
And the fiscal is going to keep on going.
and I agree with that, yes. And the Fed might have to tighten more to bring down inflation, right?
So that could be years before you get to real interest rates.
Or a big depression, or a big recession, yes.
And so somebody also mentioned, another technician said that there was we had the bubble of all bubbles, and they anticipated a larger drop in the US market than in the China market because he feels the fundamentals of China have been more solid
Yes.
because of the savings rate that you pointed out already
Yes.
than the US where there's a bubble everywhere you look, right? Real estate, et cetera. So one of our fears has been this kind of contagion where the Fed withdraws dollars in circulation. You've got all this dollar-denominated debt around the world outside the United States.
Yes.
And how does that get, handled
Yes.
when there's no dollars to be circulated?
Yeah, look, honestly, we are more short-term.
Sure.
Some of those theories we read, but there's some of them are so far-fetched in my view, right?
Okay.
That we tend to keep it more real and close to base, right?
Got it.
So what are we thinking now? We're thinking much more concrete. Interest rates, they're priced, if you look at Fed fund futures, they're priced to peak at 4%. Our forecast is that they have to go up to more 4.25%, 4.5%. Given the data today, of course, if inflation is much worse, then more than that. If inflation is but if data were to come out as we are expecting, we are thinking that equilibrium Fed funds are more 4.25% to 4.5%. We are thinking that when that happens, the yield curve should invert by about 50 basis points. So we're thinking that the 10-year should be in a range of, at the end, right, 3.75 to 4%. We think that earnings estimates should correct by another 5 to 10%, and price earnings should be more like 14, 15. So that's a thought that equities maybe can correct another 10% from here, right? We're thinking commodities after a phenomenal rally from February through June, they have corrected back to almost showing no improvement in the year, and the supply imbalances are there. So we're thinking commodities can go up 10 to 15%. And then on the dollar, I think the euro goes to maybe 90, sterling close to parity, even though that would be interesting to see. Dollar yen, I have a hard time seeing above 145. And then I think against the other currencies, the dollar gets a little bit weaker. That's how we think about things. And that's how we like to manage capital for your portfolios, with a very strong focus also on risk control and risk discipline. These longer term theories that China will implode, they might be valid, but they are not very tradable. So we tend to avoid them.
And you have a couple of different strategies, it's just not one global macro fund. Is that correct? You've got a couple of different areas that.
Yeah, so at a very high level, we have two sources of alpha. One is both are in macro. So what do you mean by macro? We trade global liquid markets, futures, currencies, equity indices. And so we trade from a quantitative standpoint, right? So we have call it 25 PhDs and masters building alpha signals and models. And then we trade that on a systematic basis, right? And then we have another source of alpha, which is discretionary PM. So these 15 different, very senior PM portfolio managers that get an allocation of capital, right? And on both businesses, we have a very, very strong, very obsessive risk control, right? Try to avoid getting into a big drawdown, having very good guidelines for the PMs to the way that they deploy capital, right? So that's at the very high level. And then if you drill down, we have a few different differentiating quantitative strategies, but all of them are global macro. And it's two different ways to approaching the macro problem. I mean, I don't think that there's an advantage to one or the other. We have a program that combines both, and maybe that's the best way to do it, because then there are environments where the discretionary PMs can do better than the models, and there are situations where the systems can do better than the PMs. So if you combine both, then that's more diversification, and that's the best way to approaching macro.
Just to jump in, so I'm with Graham and my colleague Laura Sheedy's here as well. We'll be at dinner tonight, so if you guys want to talk about any specific strategies or LPs and availability, we're happy.
Yeah, I mean, we'd love to know more about targets and, you know, where you think, you know, your
Some of the
performance will
funds,
be versus the
performance,
performance of the general market, you know, the alpha you create, et cetera. It's a very intriguing, because, you know, the banks and wirehouses will argue, you know, we're in this part, so do rotate to that. And a lot of times the rotation strategies don't make any sense, right? You know,
Yeah, so we can walk through the systematic and the discretionary and the hybrid options, you know, at dinner. Just reach out to Laura and I, for sure.
Fantastic, great. Well, great job, and thanks for, you know,